So given the recent Hong Kong market rally, Wall Street is back at it again with their quirky naming conventions. We initially had the Fantastic Four, then the Magnificent Seven, and now China's Terrific 10. So if we were to benchmark the T10 against the Mag 7 counterparts, they have significantly outperformed the Mag 7 so far this year. And the DeepSeek moment and Trump 2.0 has been one of the greatest catalysts for this change in investor sentiments. And naturally, I think as investors, we are probably wondering, is it still a good time to buy into some of these T10 names? But of course, let's not forget that many of these are just short-term performances. And like the sharp ones in the Reddit community, like Gucci Mane Ice Cream Con, he said that now, do 5 years. And even just extending this time frame of 3 years is embarrassing enough for some of these T10 names. Not forgetting that they've just emerged from their 4-year long bear market. And in our previous episode, in case you haven't catch it, I've done a comprehensive dive into the Mag 7 names, and for each individual companies, I've expressed my opinion on both the bull and bear thesis, and more importantly, my general opinion of the risk-reward the particular stock or investment might provide as a prospective or even existing investor. While we are already at it, I've might as well extended the entire discussion and took the liberty to also collate some of these key data points for these terrific 10 names. And putting valuations aside, I just wanted to first do a quick comparison in terms of the quality of the companies between the Mag 7 and the T10. And looking at just their EBITDA margin, you can see that in general, maybe excluding Amazon and Tesla, most of these tech companies all have 30, 40, 50% margins easily. However, I think if to contrast that to the T10 names, yes, we do see companies in the high 20 to 30s range, like Tencent, Baidu and NetEase. But I think for the rest of them, we have JD and Meituan, which are much lower in margins. We have BYD and Geely, which are both automobile companies with low margins as well. We have Xiaomi, which is also kind of in the manufacturing space with a high single-digit margin. On the flip side, also just comparing in terms of revenue growth rates, I think not forgetting the context that many of these Mag 7 names, they're all trillion-dollar companies with a huge amount of revenue base. I think they are probably 5-10x bigger than some of these T10 names, and they're still growing at respectable double-digit growth rates of between 10 to 15%. And of course, you have the outperforming ones like your Meta and Nvidia. On the flip side, if you were to look at the T10 names, yes, we do have big companies as well, like Alibaba and Tencent, but for both of them, they're actually growing below double digits, maybe in the high single digits. So we do have a few big growers as well, like Xiaomi, SMIC, and Meituan. But like I said, not forgetting the revenue base that they're coming out from. And before we proceed, I think for my Singapore audience, for those of you looking for a broker that offers lifetime commission-free trading for both US and Hong Kong stocks, look no further. I think Longbridge is actually a new broker in town that has obtained the license from the MAS. So currently, they're running really attractive sign-up promotions for new users until the end of March. And all you have to do is to maintain a net deposit of 2,000 Singapore dollars for 30 days and complete 3 buy transactions. And you get $50 US worth of option cash coupon and one Nvidia share worth $180. For those of you with a larger capital, you can maintain a net deposit of $10,000 for 90 days and complete 5 buy transactions. You can get one Apple share worth $320 and also the cash coupon and also 60-day 8% interest rate cut. On top of this, if you actually use my exclusive link down below, you get an additional 18 Singapore dollars affiliate exclusive. So the total rewards that you are potentially looking at is the $18 exclusive plus 66 Singapore dollars worth of options cash coupon and $180 worth of Nvidia shares. And that's $264 out of the $2,000 deposit for 30 days. And that's 13.2% yield on your capital. So for new users without a Longbridge account yet, feel free to use the link below to sign up, and please try to take advantage of this new user promotion. So I think my general view of looking at these terrific 10 companies is that be careful. Why do I say be careful? It's because when I compare this to the Mag 7 names that we talked about in the previous episode, most of them, if not all of them, scored above a B grade. And I remember vaguely that I put Apple into the C grade, mostly because of a personal issue that I have with their current valuations. But looking at the T10 today, this is my distribution of the 10 names. And just going down the list, I think out of all the 10 companies that we have on this list, I'm the most confident or comfortable with Tencent. I think Tencent, with their current scope, scale, and their WeChat distribution in the Chinese populace minds and lives, it's probably irreplaceable. And I think that I'm quite comfortable holding this company for the next 5 to 10 years, and I don't see any imminent threat to the entire WeChat ecosystem. And of course, not forgetting their gaming arm, their advertising arm, and what have you not. So it's a very diversified portfolio and went through a lot as well, similar like Meta, but hopefully they are able to turn a new chapter. Now, moving on to the A grade list, I have Alibaba and Meituan. So personally to me, actually these three tech companies are my go-to. Initially, I only have Alibaba and Tencent in my portfolio, but I've recently built my conviction into Meituan, and I've slowly been adding and building my position and exposure, especially after my recent trip back from China. I've completely changed my view on Meituan, and also because of their earnings and margins expansion and how they are turning round the corner, and we are seeing some sort of a profitability metrics coming in again compared to back in 2022-2023 when they were still not profitable. So just looking at these three companies, ATM, Alibaba, Tencent and Meituan, so they are basically the market leader of the consumer technology space in China today. So moving into the B tier, I have BYD and Xiaomi. So personally, for myself, I actually have looked into Xiaomi before, and I've talked to a few earlier investors into this company, and I've personally haven't crossed the hurdle of buying into their entire ecosystem idea, albeit giving it to them that they had spectacular executional excellence. And I think their SUV penetration into the EV markets and just the proliferation of the entire ecosystem, their smartphone, their vacuum cleaner, their IoT, whatever it is, have been very strongly reflected into their share price performance. On the other hand, I think for BYD, they really made the headlines back in the days when Buffett was an early investor. And I remember vaguely that the late Charlie Munger did praise the founder of BYD, if I'm not wrong, being the combination of Thomas Edison and Jack Welch. He just sing extremely high praises of him in terms of their operational execution and their ability to scale and just business strategy in general of being vertically integrated. And they're able to just keep pressing prices down and becoming the most competitive automobile company in China. So I do think that BYD as a car company is kind of valued to a very large extent, but I'm not too sure, which is the second part of this equation, whenever you hear Tesla investors talk about FSD or the next S-curve, other than an excellent automobile manufacturing company, I'm not too sure where do I see BYD moving forward from here. And from my personal vantage point, I think great company, great execution. I just don't know how it fits in my portfolio and whether I buy into the thesis that they have the next leg up other than just being an excellent car manufacturer. Now, moving on to the C tier, we have JD.com. Specifically for myself, I understand the allure of JD owning their entire logistics network, but if I am really interested in JD, I would rather just buy into Alibaba. Of course, understanding the valuations of JD.com today, I'll talk more about them later on. I think operationally and just the portfolio of companies that they own, I think Alibaba is probably a better pick. Moving on to the D tier, we have Geely, which is kind of the second largest competitor to BYD, and NetEase, also the second fiddle to Tencent. To me, I don't know. I just don't like to play as the second player. I like to buy the biggest, the best, and they have the largest network. And there's a reason why they continue to dominate. So for myself, if I'm interested in Geely, I will just buy BYD. If I'm interested in NetEase, I'll just buy Tencent. Unless there is a very big caveat here, is that when their valuations start to get obscene in a good way, meaning to say they get traded down by such a large extent and maybe, I don't know, below book and great balance sheet, continued growth and margin expansion, then maybe I'll consider. Last but not least, I think I've expressed my opinion multiple times on this company called Baidu, and I even made a specific video on this company. I have nothing much to say. They have slept on the wheel over the last decade. Yes, they do have Apollo Go and their FSD going, which might potentially be the next big thing, but just looking at Baidu as a company, I've kind of lost trust and faith in the management or their execution, and they've just been under delivering. And last but not least, we have SMIC. I put them between the B and C tier because truth be told, I don't really know, or I haven't really been keeping up with China's rate of innovation and technology in the semicon space. And I personally do have TSMC. So of course I'm biased, and I do think that looking just at the chip industry or ASML, TSMC, Nvidia, they are still dominating and monopolizing the entire industry. SMIC, I don't have much knowledge to comment on them, so I just put them right in the middle. So I think just looking into these 10 companies, if you're interested into my deeper dive, I actually previously made a video roughly 9 months ago where I reviewed most of the important Chinese tech stocks. And if you actually realize out of these terrific 10 names, 7 of them are actually tech companies. Your Tencent, Baba, Meituan, Xiaomi, JD, Baidu, NetEase. So I actually did cover all 7 of them quite extensively in this video. So I'll leave the link to this video in the description below. And I went on further to talk about the bull bear thesis and what you are basically buying into. So if you're interested, I think you should head over to this video. And on a side note for Pinduoduo, I do understand that in the Chinese tech investing community, quite a number of high-profile investors are very bullish on Pinduoduo. Personally, for myself, I do think that they are kind of on an unsustainable path. They're growing crazily. Their balance sheet is phenomenal. And if you do believe in the numbers, I think they do deserve a ranking in terms of business quality wise if they didn't cook the numbers. But I think just going back to this T10 framework provided by Wall Street, you can see that at least based on my Asian scorecard, anything below a B grade is considered fail. And yes, a lot of people just like to look at their performance. But for myself, I think you should restrict or even curate this terrific 10 list into the phenomenal 5. And in this phenomenal 5, it's Tencent, Alibaba, Meituan, BYD, and Xiaomi only. And just looking back at their performance, I think you cannot accuse me of just being a performance freak. Because evidently, I excluded SMIC and included Meituan, which is a so-called underperformer, relatively speaking, into my top 5 names out of these 10 companies. And diving into the first category, which is amongst my favorite, of course, it's the ATM companies, Alibaba, Tencent, and Meituan. Just looking at Alibaba, top-line revenue growth rate, they have slowed down considerably from their peak moments of pre-2020 to now between the mid-single digit. But for the next 2 years, they're expected to recover back to the high single digits. And just looking at their current multiples today, they're really not trading at demanding valuations. Forward PE of 15, price to operating cash flow of 8.8. But of course, not forgetting that in their most recent earnings, the CEO is committed into reinvesting very heavily back into the business, especially in building up their AI and cloud infrastructure. And I wouldn't even be surprised if in the next 1 to 2 years, we see price to free cash flow multiple going up or expanding to the 25 to even 30 times. So very similarly, it just means that their operating cash flow, a lot of it will be reinvested back into CapEx. And they're not doing it because of blind faith. It's because they're already seeing the demand, and we can continue to look forward and expect the cloud growth to continue ballooning and bringing in great amount of growth. So generally, I think it's still a very scalable business with a very long tailwind ahead for it. So moving on to Tencent, I think Tencent recovered a lot quicker than Alibaba, but moving out into the next 2 years, similarly also high single-digit growth rates. And I think across the board, looking at some of these different valuation multiples, they are between 1.5 to 2x more expensive than Alibaba, and rightfully so, because the business quality and the model of Tencent is a lot more resilient, a lot more diversified than Alibaba. And of course, they're also in cloud, in gaming, in advertising, and their value-added services and stuff like that. So this business is very resilient. Everybody is relying on their entire ecosystem, so they're not going to go anywhere. And probably because of this resiliency, there's some sort of a premium being attached to their valuation, even in the bear market. It's still one of the best businesses to own in the entire Chinese tech ecosystem today. Moving on to Meituan, I think Meituan is a lot more bigger or faster grower than Alibaba and Tencent, but they are starting at a much lower base, because if you look at their past history, they actually only turned profitable, I believe, 1 or 2 years back. So they have a much smaller base, they are growing much faster. You are looking at between 15-20% growth rate for the next 2 years, and they've grew coming out from 20+% from the last 2 years. So looking at their valuation metric, they can arguably be kind of valued as more of a growth company, but still not at very demanding valuations. In fact, comparable to even Tencent. And just looking at their PEG, price earnings growth, actually Meituan is the cheapest out of the 3. I'm slowly increasing my conviction, and likewise my exposure in tandem. So that's for the first category on the ATM companies. Now moving on to the second category, I don't know how to name them, but I'll just tag them under the online favorites, because in the Chinese tech space, it's a relatively small and close-knitted community, and I do see quite a lot of people basically expressing their view and opinion on JD and Baidu, saying that it's an opportunity of a lifetime. And I can understand and see where they're coming from, probably because when you look at their company and where they're trading at today, they're really trading at dirt cheap valuations. And if I may argue, out of the terrific 10 names, these two are considered the most quote-unquote undervalued, relatively speaking. But I think if you just look at the business itself, their model, their execution, and the expected growth rates, there's a reason why they're trading at a much lower valuation multiple compared to the rest. And I think I've already expressed my view. I'm really not bullish on Baidu, even though I know that it's cheap. And I acknowledge that it's cheap. And for those of you who are interested in just punting for that re-rating of maybe a 30-50% increase, I think go ahead. I'm not saying that you wouldn't make money, but just looking from a long-term approach, and I want to buy the business to allow them to compound for me, there really is no compelling story. Comparing Alibaba and JD, Alibaba at least has the AI and cloud infrastructure going for them. And JD is really just a pure play retail Amazon first party kind of rip-off. And not forgetting that they recently just said that they wanted to go into the food delivery space to go and attack Meituan's market share. And I was thinking, what are they even thinking about going into Meituan's market? And that was when I added to my Meituan exposure. Because I really don't see in the short term how JD is going to make a dent to either even the e-commerce business or even the food delivery business. On the other hand, Baidu, I think they're just cheap for a reason, and I'm not interested into getting into Apollo Go because the search business is a dying one, and bad management, bad execution team, valuations, regardless of how cheap, I'm not interested in this company. The category 3 is the surprising outperformer. So specific for Xiaomi, they actually came out from a negative growth era in 2023, and they bounced up quite quickly, especially when you have a lot of all these electronics related boost consumption in China with all the vouchers and stuff, and you are expected to continue growing out in the 20s in the next 2 years. So you can see that I think Xiaomi considerably, quote unquote, one of the most expensive ones relatively speaking, because there is still quite a good amount of growth being priced into the company. And of course, not forgetting that they're making waves in the EV company, and they're very consumer focused, great execution. So it's a relatively good company. So I don't want to discredit them from that. But from a portfolio perspective, I don't necessarily see how Xiaomi play a role for now. Now, moving on to the fourth category, it's the car companies. I specifically excluded them out of the terrific 10, the top 8, and then the other 2 companies. Because actually these 2 companies, I don't really know, you can't really call them tech companies. They're good manufacturing companies, and they're still in a very high growth industry, especially in the electric vehicle and the battery industry. But that's it. If you were to value them as purely car companies, automobile industry in general don't deserve a high multiple because there's nothing special. It's very capex intensive. A lot of the free cash flow goes back to reinvesting, and they're just squeezing in terms of their margins. So I think all things considered, I'm not very interested in getting into them. Now, moving on to category 5, it's the rest. I think you have NetEase and SMIC. So I've made my position clear. I think I'm not interested in NetEase. If I want a gaming exposure, I'll just go straight for Tencent. But of course, if NetEase comes at a very, very cheap valuation, maybe if NetEase trades at Baidu's valuation, I might potentially consider. Maybe 5 times EV/EBITDA and 10 times PE, maybe I'll consider because it's still a pretty decent and sizable gaming company. But if not, I think for SMIC, I really have not much opinions. And here's my conclusion slide. I think for investors that were not positioned earlier for this China rally, I think please don't chase it blindly. It doesn't mean that the stock is good just because the valuations got re-rated or just because it went into this terrific 10 category. And I presume how the analyst came up with these names is purely just looking at the return to date or what have you not. So that's not a good way to invest. And a bottoms-up analysis for the individual company on their execution, mode, business model is still very much needed. And of course, I'm not forgetting valuations that come in later on. So my own personal outlook is that for the vast majority that are not comfortable with having a big exposure to China, please size your allocation appropriately and don't FOMO just because they seem to be more resilient in the short term when you compare to some of these other US names that are being embroiled in this whole Trump tariff recessionary scare. We don't need to argue that the quality of the US Max 7 is multiple times better than the Chinese T10, but they're also valued at multiple times higher. So investors have to make their own risk-reward assessment on which stocks to own, considering all the different factors. Personally, I do still have a sizable exposure to some of these Chinese names because I do see a lot more upside from here. There is quite a lot that the market is not appreciating. So with that in mind, I'll see you guys in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye.